SMB Investor with Nick Bryant and Sean Smith.
Hey everyone, you got Sean Smith here, managing partner of Search Fund Ventures and founder of SMB Investor Network. And today I'm joined by Christien Louviere of BDE Capital. Christian's got a great track record as a leader and as an independent sponsor and a founder, and he's going to share with us all about his journey and some tips for folks that are looking to buy businesses. So, Christian, I'll let you take it from there.
Hey, Sean, thanks for having me. I appreciate it. Start off by saying thank you for doing the show and all the information that you're giving to the community. That's really helpful. So my background, again, I'm co-founder of BDE Capital, stands for Bernard Davis Edge Capital. My background is about 20 years in venture capital, B2B SaaS for the most part. Got my start all the way down in a seed company based in New Orleans, and then started working my way up into venture capital backed companies, more traditionally out of Silicon Valley. Went through an acquisition by Oracle for about 330 million. And at that company, I was leading one of the biggest revenue generating teams. It was a company called Vitru, and we were purchased by Oracle. After that, I was doing consulting for founders and other CEOs who are getting seed funding I was doing that for about 10 years, helping them see the mountain, seeing the forest for the trees, and helping them avoid some of the common roadblocks that come from building your own company. During that time, I also started two of my own companies. I raised seed funding for a company called Stroho, which was an air filter subscription company. We got that to about 100,000 in revenue, and we launched at a time when Amazon Prime decided to release. So we made the strategic decision to let Bezos do his thing, and we downshifted on that one. And then the other one that we ran is a direct consumer e-commerce company. We grew that to around 1.5 million in revenue. Yeah, what happened is we were always trying to build a portfolio of companies for BDE Capital, and decided that the independent sponsor route was going to be our best path forward. So that's how we got here.
Very neat. So yeah, lots of good kind of founding and investing experience. And it seems like it's attracted you to the independent sponsor world is the fact that you've got sort of a starting point. You buy one of these businesses, it's got an established revenue and kind of earnings base that you can then use to roll out a lot of the playbooks that I think you and I had talked about in the past. Is that a fair way to chalk it up?
Yeah, it is. I've done the 0 to 1 myself. I've done the consulting for the companies that are 0 to 1, meaning trying to grow from nothing. And I think that it just takes a certain energy level to do that. And so part of us building BDE Capital was that we don't think that we have the right energy to do that anymore, because you've kind of like seen behind the curtain. And the other thing that we saw behind that curtain was a litany of companies that are able to get to around 3 to 5 million in EBITDA, but don't really know how to scale past that. And we felt that, or we know that we can do that, and felt that we could provide tremendous value there in helping founders or the original team that is running that company get to that next level with our expertise and our access to capital.
Sure. And when you started out, you had considered kind of building a portfolio by taking companies from 0 to 1, almost like a venture studio type approach. But that's evolved into a buy then build type approach. Has your industry focus changed at all, or have the types of attributes you look for in a company, has that changed, or has it always been somewhat similar?
It's been somewhat similar. We are about 80% healthcare focused and 20%, I'll say very broadly, B2B services focused. That has not altered much, and that just simply stems from the 20 years of experience that I have and my business partner have.
Yeah, that makes good sense. So when it was starting companies, I imagine it was more focused on software type strategies within healthcare and within B2B services. Do you still look at software, or do you more look at, call it, old economy type business models?
We will look at B2B SaaS on a one-off situations. And the reason for that, not to go to PhD here on the SaaS funding space, but a lot of the big flashy funds that you saw back in the day, let's say pre 2018, were heavily built off enterprise sales models, right? Trying to get to these big contracts and then parlay that into the next funding round or a large exit. That trend was already starting to come down pre-COVID. Then once COVID hit, it just got accelerated as CFOs started finding places to cut costs and things of that nature. And then with AI coming on board, that's been accelerated again. And so the market for a lot of large SaaS players is highly inflated on price. And so we're very, very cautious of looking at companies like that. Having said that, we have looked at several niche SaaS businesses that were built around not having an enterprise sales layer. And so we have looked at a few kind of in that ballpark.
That's an interesting area of focus. It's not one I think we've talked about a lot, but I think it's pretty typical of investors and independent sponsors, search entrepreneurs, anyone buying businesses to focus on the quality of revenue and the quality of customers. And in a sense, right, if you're focusing on enterprise sales, those are really long sales cycles. You're probably going to end up with some serious customer concentration if you get one or two big contracts. So it's very analogous to a lot of the things you hear other searchers and sponsors and investors saying, which is we want to limit customer concentration. We want to have lots of kind of customers that have generally shorter sales cycles and recurring contracts in nature. So it seems like some of those concepts, part of what drove your decision, in addition to the, call it headwinds that were facing the SaaS enterprise sales model itself. Is that fair to say?
Yeah, you got it for sure.
So when you find a target, it fits all your criteria for the business. What do you look for in leaders that you partner with? Because you guys aren't always going in to be the CEO necessarily, right? You're going to find some folks that might be supportive there.
We're looking for founders or successors that have a clear vision of what they want to do with the growth capital. So we want to hear that first. And then the second thing we are usually pulse checking is figuring out how that cash flow is coming in their sales model and figuring out how reliant it is actually on that management team. And if they've clearly built out something that if they get hit by a bus tomorrow, the business isn't going down, then those are kind of two criteria we look at quickly to figure out if we even want to pursue looking at that deal further.
Got it. And your structure is a mix of, a majority acquisition, but there's a substantial amount, typically from my understanding, of rolled equity or some other type of incentive in there, right? So that you're really kind of bringing the successor or the operator into the mix as a material owner. Is that the right way to think about the deals you're putting together?
Absolutely. Every deal we're looking at, they're running between 20 to 40% roll on equity from the existing management team. There's one deal that we looked at that falls a little bit outside of that. It would be considered more middle market. It was a much larger transaction. We were bringing in an outside operator to that situation because he had very specific knowledge to the business. But he was going to roll 25% of his ownership into that new entity. But in most situations, we're asking the existing owner or founder to roll 20 to 40%.
And at the 40% range, that's, a lot more than we see in many of the deals we're doing, but probably is more akin to, makes more sense for larger transactions, right?
Yeah. And it helps separate us a little bit too, though, right? When we get into some of these processes, it helps us understand that we're not competing purely on price. We have to be competitive on price. But if somebody's rolling that much meaningful equity, then it means they're committed to the vision moving forward. And that kind of helps separate us a bit more from a traditional private equity firm that's going after them.
Absolutely. And it also changes the dynamic of the negotiation process because now there's much more, call it onus on you guys to sell your vision, to sell yourselves as operators and as value creators for the business, right? Because someone's rolling 40%, they practically half their proceeds, or substantially more than that if there's success from a second bite at the apple, per se.
Yeah, and it's interesting you mentioned the second bite of the apple. Is several of the deals that we've gotten really involved in are second, and one of them was a third bite at the apple type situation. And they've kind of been burned by traditional private equity processes and had seen the baby that they built not thrive post acquisition. And we're able to play on that in some of these situations. I also think, yeah, I mean, it's interesting. We'll go in there modeling, right? We'll show them the dream of like the 5 to 10 year model that every PE firm is showing them. but we're instilling trust that we're there long term, and we want to see, we're strictly modeling because we have to. We have to have a benchmark, right? We have to have something to go against. But we talk about how it creates optionality from a strategic standpoint moving forward to achieve their vision, as opposed to, yeah, we're going to get this up to, in 5 to 7 years, and then we're going to flip it. And when you help educate the seller to something like that, they don't live and breathe this stuff. They don't know that, right? They just hear from their friends that private equity may not be the best option. So you have to educate them on that and help them understand and help them have belief in you that you're gonna take it for the long haul. I think that goes a long way when we're speaking to these sellers.
And it's a good tip for anyone who's thinking about buying a business or investing in an independent sponsor deal or self-funded search deal. If you follow a dollar through the business and how it ends up in either the seller or the sponsor or an investor's pocket, the more aligned things are, especially with mechanics like rolled equity or an earnout to some degree. But rolled equity really forces people to focus on that ultimate income because it's putting folks in the exact same boat as investors. And I think when we see, call it 20% plus rolled equity, generally you want the seller to be pretty materially involved post close. Because if someone's
Yes.
rolling equity, but they have no sort of control or no influence over the second potential outcome, you could potentially end up in a place where they just write off that portion and start negotiating heavily for the cash at close. Right. So that there is a
Yeah.
balance. I imagine you have probably some experience with that as well.
The balance comes into what I mentioned in that first part of the process of just understanding how to read the room and read people and understand what that trust is. And then when you go to roll their equity, it's not just equity. They have milestones that they have to hit, right? There's things that are hold true to that. And I came from sales leadership, right? So I kind of understand, you're showing them what this incentive plan is on day one. And then if, they're going to match it, then you have to hold them accountable to that incentive plan. And in this case, it's just a bigger vision, right? And that's my methodology for making sure that that happens.
That's a great point and probably worth unpacking as well. A lot of rolled equity plans that we've seen are just kind of a figure. They have no clawbacks, they have no vesting, nothing like that. It's simply, hey, these are proceeds that you would have received hypothetically in cash, but you're receiving them as a unit or a share. So how you structure those, I guess, clawbacks or contingencies or milestones, what does that look like?
We try to keep it very simple. It's pretty straightforward in terms of, look, you have to hit, we're going to pay out 10 million, but in order to get that, you've got to hit these numbers. And the clawback piece of that, we make sure they understand it in principle, but we don't drown them in the details when we're trying to make that deal happen. But we let them know, look, you got to hit this certain number. It's got to maintain. It has to pan out at the end of the year. Otherwise, comes back to bite all of us. Nobody's getting anywhere they want to be. So
It's a great structure. I mean, it combined dynamics of an earnout or a forgivable seller note, which is more capped in nature, with sort of an uncapped potential upside that still requires hitting milestones and that creates that accountability. So I think that's a great one for investors, buyers to look out for when you're kind of structuring deals or you're looking at deal structures. Keep in mind that rolled equity doesn't have to necessarily be a fixed amount at close. There can be clawback features that you can introduce.
yeah, and it's interesting you mentioned the seller note. I find that once we get above around 3 million in that zone, 3 million of EBITDA, I find the seller note tends to be less common, or at least for us, it hasn't been really a talking point in a lot of deals. Like, it's not something that, it just takes us out of the competitive piece of it if we try to do a seller note above a certain level in the lower middle market. So we don't leverage that tool too much above that range.
Yeah, once you flip out of using SBA loans to finance the deal and you get more into the conventional debt land, you get more
Mhm.
flexibility with earnouts. And I think, imagine sellers who are getting bids from private equity that typically have a combination of cash at close, earnout, and rolled equity. When you come in with a seller note in there, that's basically just less attractive than the other two in most cases.
Yeah, the clawback's a lot easier just to be competitive on the front end, and then you can always make it up later if something you're not quite aligned. But like I said, we're only going after spaces or founders and jockeys that they actually care about what's going to happen on the back end and long term. So
That fundamentally underpins the ability to even use a mechanism like rolled equity, right? Because if you have someone who doesn't want to participate, then it doesn't matter in the first place. Well, switching from kind of the jockey to the horse, what do you look for besides kind of the typical low customer concentration, recurring revenue, all the kind of quality business metrics that everyone talks about? What do you look for that might be unique in an acquisition target?
yeah, besides the traditional things that you mentioned, we really look hard at the talent. So the talent that's on the team and what they're bringing to the table, and you don't always get access to that talent in this process. Fortunately, there's a lot of things you can do online with AI to investigate the way that the company's been functioning, the way that maybe an individual functions. So we'll take a look at a lot of things like that. One of the things that we've been able to leverage with several AI platforms is running scenario analysis based on how the team might be functioning or what their skill set might be. Things that you and I could not have done prior, or it would have taken some type of specialist. But the ability to run scenarios with the existing team, maybe being able to download, get the 10 members that are running management off LinkedIn, being able to put that into ChatGPT or Anthropic, and being able to do scenarios of what if, it has been a big game changer for us as well in creating some sort of edge. Yeah, so that's one way. One
That's
thing
pretty
that we
neat.
do.
Yeah, so let's unpack that a bit because that's certainly unique. So you can look at, call it the 5 to 10 folks that are line managers, and you can ask, one of the language models how it might impact your assumptions if they act a certain way post close, or tell me about how you do that.
Yeah, so I'll give you one that we just did. We actually ended up just passing on a deal. I'll say on this particular deal, they were doing about 35 million in top line. They are in prefab construction, and we were looking at we took their financials and we matched it up. We put along with that information the LinkedIn profiles of 5 of the people from their leadership team. And what we were trying to figure out is how much of the sales would have taken place if they had not had the relationships they had previously. And then also, how is that affecting their margins? Like, was that changing a lot? And it turns out that they were in this situation because when they started the company, again, it's scenario analysis, so it's not completely factual, but it definitely helps us like tease out that problem. We found out that when they started out, their margins were double in the mid 20s, and their sales were fantastic. What we kind of deduced is that it was because when they started, they leveraged all their industry relationships to get the company off the ground. That lasted for about 3 to 4 years. And then once they had to start building a system, all those started shrinking. When you have to hire a new sales team to replace you and things like that, that's when the rubber meets the road. And we felt it was going to be a risky investment. And so we pulled away. To me, that's edge that is not on the surface level of the sim and the financials.
Yeah, certainly. That's a really interesting exercise that I think a lot of folks could benefit from. I mean, if you take that same concept and say, we talk a lot about key person risk, and every deal we do always has some degree of key person risk, right? So if we talk about taking this same form of org structure or team scenario analysis and saying, what would it look like if the GM doesn't kind of stick around and we're going to need to spend time finding a new GM, or they take relationships with them, that kind of thing. I mean, we talk about kind of different scenarios within our portfolio. If something like that happens, is it sort of a business as usual scenario? Is it a contained spill, or is it a real problem that kind of flows throughout the organization, impacts customers, creates turnover? So I think that's a great thought exercise and almost like a different version of a Monte Carlo simulation focused on the team. And then of course you can take those assumptions and plug them back into your own financial model to get a sense for what it means for, credit metrics, what it means for return profile, all that stuff. Really, really cool.
Yeah, thank you.
So what else can you share about, I would say, tips from deals you've seen? And maybe it's also in the venture world, right? Like what kind of parallels have you seen throughout your investing and founding career to the independent sponsor land?
Yeah, I'll start off with like some of the edge that we thought and seemed to be right about from venture world is that the traditional private equity game is create value through cost cutting, and my world has always been created through growth. And so when we go to model out the 3 or 4 scenarios on an acquisition, we are trying to figure out what that scale and growth model look like going forward. So I would say from a venture capital perspective, that's where my experience really parallels here. So that's the first part of your question. The second piece is kind of some of the things to look for. I got a really good tip from one of our financial backers, and that is probably about 4 months ago. We're having coffee, and he really starts to tell me about the gray area and lower middle market between the $3 and $8 million mark. Like you have something in like your life where you kind of know it's there, but you can't quite put your finger on it. And one of the things that he pointed out that's really helped us is at that 3 to 5 million, they used to invest in a lot of companies in that range because they thought they had a middle management layer in place in the next leadership. And what they started finding out was sometimes they did, but really what was happening is they were testing it. And these guys who are this private equity shop, they're becoming the guinea pig for them to really prove it out. They're using that capital for that. It's not always the case, but sometimes it is. And they got to the point now to where they don't really look at anything until it's around 7 million in EBITDA, and it's really kind of proven that that leadership level exists. And that's been a really great insight and has helped us with our lens looking at some of these deals. I've been a founder. I've been in the trenches with founders. It's not always that these sellers are doing anything. They're trying to be bad actors. It's just they think they made something work once for a year, and so they think it works. But until it's been battle tested, 3 years plus, then it may not be what you think it is on paper. And that lens has helped us tremendously when we're looking at deals. So that would be something we've really learned about this.
Yeah, it's a great tip. We have looked at deals on a pretty wide spectrum. We've looked at stuff as low as 500K in EBITDA. I mean, we've received teasers for deals well below that. And we've looked at stuff all the way up to, 15, 20 million in EBITDA, which is too large for us to invest in. But again, we've seen kind of the profiles. And I think to your point, it's just a totally different approach. And even in the middle, that 3 to 5 million range, that's where I think you can see a lot of variance just within a similar size of business, right? Some of them have great established kind of management infrastructure, good processes, SOPs built out, and they are a battle-tested machine, as you put it. But others are still very much kind of founder-led. The founder's taking most of that EBITDA down as a distribution. And I'll give you an example. We looked at one business that I had probably 3 or 4 full-time employees, and the rest was entirely contracted labor. And it was doing around 3.5 million in EBITDA. And virtually all of that was going to the seller, but the seller had a very technical skill set and relationships with suppliers that they could then kind of have contract labor implement, right? So in that case, it's really hard to transfer that value. There's no middle management. Most of the know-how and the value of the business sits with the owner, but it's still a $3.5 million business, which on paper seems like it should have some processes around there to get there. So it's hard to tell.
Yeah, absolutely.
Awesome. Well, why don't we close out with any good stories you want to share from your founder days or portfolio companies?
Yeah, I mean, this is going way back. I'll go back to the first acquisition I was a part of, where I was actually an employee. But it goes back to my first insights into understanding how the game is played on the acquisition side. So we were at a company that was being acquired by Oracle. I already mentioned it earlier, but one of the things that I saw leading up to the place where we got acquired is I got to see the other players in the bidding war, and I got to see how other companies were like, oh, it's worth this much, and then somebody else is worth this much, and then one of the buyers was super smart and like basically put up or shut up and went and bought the competition. to set the market price. And that buyer was able to eventually make the best returns on the whole sector because they were like bidding it up. And then they're like, okay, while you guys are looking over here, I'm going to go buy your competition for what I think the valuation is, set the market. And then, we ended up getting acquired. A couple others in the space ended up getting acquired. But it was really a big lesson in understanding how the game on that side of the curtain is being played. And I think about that probably just about every deal I look at, not consciously. I'm not like, it's not an active lens, but that experience is there in my brain. And so I'll be thinking about what kind of 4D chess is taking place that I may not be privy to.
Yeah. That's a great concept, kind of harkening back to the classic strategic alternatives thought process, right? Like while you're in the trenches, try to keep from getting too much of the blinders on and thinking about either is there another good opportunity to deploy capital, or even is there another path we could be taking that would eventually end up at the same finish line. So that's a good.
Yeah, it's a great way to put it, Sean.
Excellent, Christian. Well, thanks so much for joining us. Any closing remarks you want to make?
I would say everybody have some type of partner or mentor or sounding board if you're going to be involved in this game. You definitely need somebody checking you so you're not making a bad deal or a decision that you're not looking at completely clear. You're never going to have 100% of the information, but have some type of partner in it, and it's an excellent space to be in.
That's great feedback. Yeah, the partnered searches and even just if it's a mentor, advisor, investor you trust, it's such a great way to make sure that you're staying honest and not getting too down the rabbit hole when you shouldn't be.
Yeah,
Very good.
Absolutely.
Appreciate it. Thanks for joining us.
Sean, thanks for having me, man. This was great. I appreciate it.